Welcome to the Deep Dive. We're here to plunge into source material and pull out the insights you really need. Today, we're looking at Giverny Capital's 2017 annual letter to its partners. Now, this isn't some dry, dusty report. It's actually a pretty candid look from a well-respected investment firm. It reveals their philosophy, their performance, the good, and, interestingly, the bad, and their market observations. It's like getting an inside look at long-term investing in action.
Exactly. And our mission here is simple. To boil this down for you, we want to extract the most important nuggets of knowledge. Think of it as a shortcut to understanding a really disciplined, long-term investment approach, plus the practical side of managing money day to day. We expect some surprising facts, maybe a few aha moments for you as we walk through these sometimes complex financial ideas.
Okay, sounds great. So let's start at the beginning. Giverny Capital's origins. What's the story there?
Well, it really started over 2 decades ago. The founder was duckily inspired by the investment legends, people like Warren Buffett, Benjamin Graham, John Templeton, Philip Fisher, Peter Lynch.
The usual suspects, the greats.
Right. And after 5 years managing a family portfolio, they called it the Rochon Global Portfolio, and given good results, Giverny Capital Inc. was officially launched. That was 1998. So a steady build-up.
And the team grew around that core idea.
It did, steadily. Jean-Philippe Bouchard, JP, he was the first employee back in 2002. Became a partner later. Then Nicolas Lecuyer and Karim Primo joined in 2005, also partners now. And they even expanded to the U.S. in 2009. Set up an office in Princeton, New Jersey, led by Patrick Leger, who really shares that same culture, that long-term view. It's very much about shared values.
That makes sense. And that leads right into their core philosophy, doesn't it? This idea of managing client money exactly like their own.
Precisely. It's not just marketing speak. The founder genuinely manages client portfolios the same way he manages his own money. And that's why they call their clients partners. It creates this in-the-same-boat alignment, which builds trust.
Right. And the annual letter itself, it's more than just performance numbers, isn't it?
Oh, absolutely. The main goal isn't just to talk about last year's results. It's really about explaining the philosophy behind why they pick the companies they do. They have this core belief, short-term, this market's irrational, maybe crazy, but long-term. It reflects a company's real intrinsic value. So if your selection process is sound, rational, well, the return should follow eventually. They're very transparent about all this.
And they even add a little artistic flair, right, with the letter covers.
Yeah, that's a nice touch. Since 2004, they've used artwork from their corporate collection. The 2017 letter we're looking at features a painting by a Quebec artist, Anthony Burnham, called Beside Itself. Just adds a different dimension.
Okay, let's dive into those numbers then. Performance. Starting with the main one, the Rochon Global Portfolio. What did 2017 look like?
Okay, so for the year ending December 31st, 2017, the portfolio returned 13.1%. The benchmark did 10.2%. So that's an outperformance of 2.9%. But there's a catch for that year.
Oh.
Currency. Both the portfolio and the benchmark returns for 2017 included about a 7% loss because of Canadian currency fluctuations. That's a pretty big hit.
Wow, yeah, 7% is significant. But that's just 1 year. What about the long haul? That's what they focus on, right?
Exactly. And here's where it gets really interesting. Since inception, that's July 1st, 1993, the Rochon Global Portfolio, well, it achieved a compounded annual growth rate of 15.7%.
15.7%.
Okay.
And the benchmark?
The weighted benchmark was 9.2%. So you're looking at an annualized outperformance of 6.5% over 24 years.
6.5% annualized for almost a quarter century. That's seriously impressive.
It really is. And that long-term currency effect you asked about. Over the full 24 years, the U.S. dollar actually depreciated just 2.1% against the Canadian dollar, which only translates to a tiny minus 0.1% effect on the annualized returns. So pretty negligible long-term.
And they have a target for this kind of outperformance.
They do. Ambitious. But they aim to beat their benchmark by 5% annually over the long term. And just to put the total numbers out there, 398.5% total return for Rochon Global versus 767% for the benchmark. That 6.5% annual difference really adds up.
Okay, let's zoom in a bit. What about the Rochon U.S. portfolio? That's in U.S. dollars. How did it do in 2017?
Right. So in 2017, the U.S. portfolio returned 19.7%. The S&P 500 did 21.8%.
Ah, so underperformance there by about 2.1%. Why was that?
Mostly down to holdings. A lot of the big S&P 500 winners that year,
Yeah.
Apple, Microsoft, Amazon, Facebook, Giverny didn't hold them. I think Alphabet was the only one from that kind of mega cap tech group they had in the portfolio at the time.
So sticking to their knitting, even if it meant missing out on some popular names that year, What about the long-term U.S. picture?
Still very strong.
Yeah.
Since that 1993 inception, the Roshan U.S. portfolio returned 2,980% total. That's 15.0% annualized. Compare that to the S&P 500's 863% total return, or 9.7% annualized. So they added 5.3% annually over the long term in the U.S.
Which brings up a key point. Underperformance happens. How do they frame that? How do they handle it?
Yeah, they're very upfront about it. They actually expect to underperform the S&P 500 about a third of the time. They call it their rule of three. So maybe 8 out of 24 years, something like that.
So they bake into expectations?
Exactly. And they really strive to remain impervious to short-term results, as they put it. Stick to the process.
That sounds easy, but must be tough in practice.
Oh, absolutely. Especially when the market's hot.
Okay, what about Canada? They launched the Roshan Canada portfolio in 2007. How did that fare?
Canada was a big winner for them in 2017. It returned 27.4%. The S&P TSX index only gained 9.1%.
Wow, that's huge outperformance, 18.3%.
Massive. And long-term, too. Since 2007, the Canadian portfolio is up 509% total, 17.8% annualized.
Yeah.
The TSX, just 73% total, or 5.1% annualized. So they've added 12.7% annually in Canada since '07.
That's even higher than their U.S. returns, but it's a more concentrated portfolio, right? How do they manage that risk?
It is more concentrated, yeah. But they feel about 20 securities is a good balance for diversification while still aiming to beat the index. And crucially, you have to remember the Canadian portfolio is only about 15% of the total Roshan Global portfolio. So the overall diversification is still there.
Got it.
Plus, they make a point that their key Canadian companies are all led by what they call exceptional CEOs. That's part of their risk management too, quality leadership.
Okay, let's pull back again. The broader market environment in 2017, what were the key themes Giverny highlighted?
Well, 2017 was generally a strong year economically. S&P 500 profits were up nearly 12%. And as we mentioned, those U.S. tech giants, Apple, Microsoft, Amazon, Facebook, Alphabet, they were huge drivers. Average gain of 47% for them, more than double the S&P 500 itself.
And looking ahead to 2018 at that time, the big news was U.S. tax reform, wasn't it?
Absolutely. Passed right at the end of 2017. Meant much lower tax rates for U.S. companies going into 2018. Giverny thought that consensus profit growth estimates for the S&P 500, around 15–18%, might even be too low.
And for their own portfolio.
Since about 80% of their portfolio was in the U.S., and they held companies that historically paid pretty hefty taxes, well, they expected their own portfolio's profit growth could be above 20% in 2018. It even helped their Canadian holdings that had U.S. profits. So a significant tailwind expected.
So if the U.S. was booming, what was the story in Canada that year?
Canada was quieter. The S&P TSX gained 9%, decent, but lagging the U.S. Oil prices were volatile, started around $56, dipped to $44, ended near $60.
Did Giverny have concerns about Canada?
They did. A few things. That $60 oil price, still below the total cost of production for some Canadian oil sands operations, plus the rise of electric cars. Well, that wasn't seen as a great long-term signal for oil demand.
What about housing and debt? That's often a topic in Canada.
Yeah, they touched on that too. Canadian home prices were holding up, average around $500,000 then. But Giverny viewed that level as, quote, unsustainable compared to GDP per capita at the time.
Unsustainable. Strong word.
And related to that, household debt, highest in the OECD, they noted, at 101% of GDP per capita. They felt that would be difficult for the economy to handle when things eventually, return to normal.
Oh.
Seems quite cautious, maybe even bearish on that front.
And the U.S. tax cuts? Did they see implications for Canadian competitiveness?
They did. They used this analogy that high taxes have the same effect on investors as cold weather does on geese. They fly off towards more favorable climate. So a real concern that the U.S. changes could make Canada less attractive for corporations and investment.
Interesting. Did they look at any of the newer, perhaps hotter Canadian sectors like AI or cannabis?
They mentioned them, yeah. Both saw a lot of activity in 2017. But Giverny's philosophy kept them on the sidelines.
Why?
For AI, they felt it was just too early to really understand the business models, the long-term financial potential. And for cannabis, while the companies were trading at really high valuations, seemed like years of future growth were already priced in. Classic Giverny wary of speculation.
Okay, quick hop across the pond. The UK and Brexit, loss of doom predicted. How did 2017 actually play out?
Well, the predicted economic apocalypse.
Yeah.
It didn't happen, at least not in 2017. GDP growth was around 1.5%, which, given the uncertainty, was pretty acceptable.
And did Giverny see opportunity there?
They did. They mentioned taking advantage of the stock market gloominess surrounding Brexit to actually buy two British companies for the portfolio,
Yeah.
seeing opportunity where others saw risk.
Right. Now, the big one for 2017 discussions, Bitcoin. They must have been asked about it constantly.
Oh, definitely. It was the absolute flavor of the day, as they called it. Earned the top prize for financial chatter.
So what was their take? Were they tempted?
Not at all. Their perspective was, well, pretty skeptical. It acknowledged it's a new way to transmit money. But then they quoted Warren Buffett, basically saying, sure, it transmits money. So does a check. Our check's worth a fortune.
Huh.
Yeah. They observed that, rational arguments often don't stop people from getting sucked into speculation, and that these things usually end badly whenever a speculative fever sets in.
But what made Bitcoin so appealing then? Why did it catch on so strongly?
They described it as this kind of explosive cocktail. Brilliant marketing, appealing to people who want to rebel against the system, and maybe feel smart understanding this complex new cyber currency thing.
Right. The allure of complexity.
Exactly. But Giverny's conclusion was blunt. Intelligence and rationality are two different qualities. Reason and experience, they said, dictated avoiding Bitcoin.
Okay, let's shift focus a bit to the more human side of investing. Giverny paid tribute to Robert Wilmers, the CEO of M&T Bank, who passed away in late 2017. He sounds like he was quite important to them.
Immensely important. Wilmers led M&T Bank, based in Buffalo since 1983. Giverny had been shareholders for over 18 years. The founder clearly had huge admiration for him, calling him not just a great banker, but an incredibly generous human being.
What was their investment journey with M&T like?
Well, they first bought shares back in 1998, added more in early 2000, interestingly, when everyone else was chasing tech stocks.
Yeah.
And M&T did really well during that 2002 market crash, became their biggest holding for a while. Wilmers managed it very cautiously, but still grew the bank's intrinsic value significantly.
Sounds like a dream holding. But then things got interesting, right? Around 2007.
Yeah, a real twist. In 2007, Wilmers decided to retire. He was 73. Giverny met with the company, presumably the succession plan, and they felt, let's say, less comfortable with the new management. So they actually sold their shares, around $100 a share then.
Wow, okay, so they got out.
They did. But then the great financial crisis of 2008 hit. And in a quite remarkable move, Wilmers decided to come back to run M&T through the storm.
No way! He came out of retirement.
He did. Giverny met with him again in August 2008, and by February 2009, they were buying M&T shares back this time for about $36 a share.
From $100 down to $36, and they bought back in.
Yep. And by 2017, when he passed away, the stock was trading around $190. Giverny explicitly credits Wilmers for creating significant wealth for their partners, citing his boundless devotion to everyone involved with M&T. What a story.
That is incredible. And there was a personal connection, too, involving art.
Yeah, a lovely anecdote. Shows Wilmers' character. After a meeting in Buffalo in 2008, Wilmers arranged for Giverny's founder to have a private tour of the Albright Knox Art Museum, even though we're closed. The museum director there admired an Italian art collector, Count Giuseppe Panza di Bumo, and he connected the founder with Panza.
So a bank meeting led to an international art connection.
Pretty much. The founder read Panza's autobiography, became a huge admirer, called him the greatest collector of contemporary art in history, even a mentor. They actually met Panza in Italy in late 2009, just about 6 months before the Count passed away. And the founder said none of the connection, the friendships in Buffalo would have happened without Bob Wilmers' generosity. It's amazing how things connect sometimes.
Truly. Okay, let's talk about learning from experience. Giverny does this 5-year postmortem analysis. What's that about?
It's a systematic review, looking back 5 years later at decisions they made, trying to learn from what worked and, importantly, what didn't. So in this 2017 letter, they look back at their 2012 letter. Back then, they'd said equities seemed undervalued and would likely be the best asset class.
And were they right?
Well, the S&P 500 went up over 87% in the next 5 years, doubled with dividends. So yeah, pretty good call. They specifically looked at two companies they bought in 2012 and still held, LKQ and Union Pacific, the railroad.
Okay, how did those pan out?
LKQ was bought around $15 in April 2012. By end of 2017, it was $40.70. Its earnings per share grew about 17% a year over that time. The stock's annualized return was 19%, beating the S&P 500's 15% by about 4% per year. So solid.
And Union Pacific, UP.
UP was bought in July 2012, around $60. Ended 2017 at $134.10. But here's the thing. Its earnings only grew about 7% per year.
Only 7%, but the stock did well.
Yeah, the annualized return was 18%. That beat the S&P 500's 14% by 3% per year.
So how did the stock return so much more than the earnings grew?
That was mostly down to the PE multiple expanding. The market became willing to pay more for UP's earnings.
Right.
Giverny felt the higher valuation was justified by UP's quality, its fundamentals. But they also noted they don't expect that kind of stock market revaluation boost going forward. It highlights that stock returns can come from earnings growth or multiple expansion.
Very interesting distinction. Now, maybe my favorite part, the podium of errors. They actually rank their mistakes.
They do. It's incredibly transparent. They share their best errors constructively, aiming to always improve. They quote Benjamin Franklin. The man who does things makes many mistakes, but he never makes the biggest mistake of all doing nothing.
Love that.
And they stress that errors of omission, not buying something you should have, are often way more costly than errors of commission, buying something that doesn't work out.
Okay, let's hear the medalists. Bronze.
Bronze medal for errors goes to Knight Transportation. They owned it from 2003 to 2011, sold it for something they thought looked cheaper. Then they bought it back in early 2015, impressed by the new CEO, David Jackson.
Okay, second chance.
But then they sold it again in March 2017 for around $33, just a small gain. Again, chasing something else they thought was more interesting.
Uh-oh. What happened next?
Right after they sold, Jackson led a major acquisition of Swift Transportation. Suddenly, the growth outlook looked fantastic, like a 58% EPS jump expected for 2018. The stock shot up nearly 50% after Giverny got out. Their diagnosis: a simple lack of patience. Selling too soon.
Ouch. Okay, silver medal.
Silver goes to Intuit, the software company, Quicken, TurboTax. The founder loved their products for 25 years, but he always thought the stock looked too expensive.
Always too expensive. I feel like I know where this is going.
Yep. He remembers Microsoft trying to buy them in 1994 for what seemed like an exorbitant 30 times profits. Regulators blocked that deal, and Intuit stock briefly fell below $5, split adjusted in 1995.
A chance to buy.
You'd think. But no, he kept following it, kept liking the company, but still always found the stock too expensive, never bought a single share.
And the result.
Today, Intuit trades at $164, up 3,200% since 1995. That's a 17% annualized return he missed entirely. A massive error of omission, just paralyzed by the price tag.
Wow. That's gotta sting. Okay, the gold medal error.
The big one.
The gold medal, they call this a high-caliber error, goes to FactSet Research Systems. Story starts in 1998 at a tech conference. The FactSet co-founder stood out. No flashy presentation, just taped sheets of paper showing 20 years of steady sales and profit growth. Giverny's founder liked his old-fashioned manner.
So he liked the company. It sells financial data, right?
Right.
Giverny must use them.
Exactly. FactSet competes with Bloomberg, great product, loyal customers, very profitable, strong balance sheet. Giverny actually did buy shares in 2003, but sold after a small gain. Bought again briefly in 2006. Sold again.
Why keep selling? Same reason every time. Valuation's too expensive. Always looked pricey. But despite that, FactSet just kept delivering exceptional results. Grew profits right through the 2008-09 recession even.
And the stock.
Traded under $8 in 1998. 20 years later, hit $200. That's more than 25 times your money, an 18% annual return.
And the final irony.
The final irony is that Giverny Capital itself is a loyal customer of FactSet Research. The founder says, "Our familiarity with the product and our loyalty to the company should have turned the light on in my brain." Another huge miss due to focusing too much on valuation multiples instead of the quality and resilience of the business.
Incredible honesty. Okay, let's talk about how they do value companies. This idea of owner's earnings. What is that?
Right. It ties into seeing themselves as business owners, not stock traders. They don't obsess over daily price swings. They focus on the underlying business's earnings power and long-term prospects. Since '96, they've used Warren Buffett's concept of owner's earnings. It's basically the cash earnings a business generates that could theoretically be distributed to owners without hurting the business's operations or growth prospects.
How do they calculate it?
They acknowledge it's not precise, but they approximate it using EPS growth plus the average dividend yield. The idea is to be roughly right than precisely wrong about the growth in the company's real economic value.
So how did that intrinsic value growth compare to market returns in 2017?
In 2017, they estimated their company's intrinsic value grew about 14%. Their portfolio's market value, though, gained about 20%, net of currency effects. For comparison, the S&P 500 companies grew intrinsic value maybe 12% or 14% with dividends, but the index total return was 22% in US dollars. So some multiple expansion happened across the board that year.
And long term. Is there a strong link between their owners' earnings growth and their stock returns?
A very strong link. Over 22 years, they calculate their companies grew intrinsic value by about 1,391% total. That's 13.1% annualized. and their stocks. Total return of 1,544% or 13.6% annualized. Very close.
Okay, and the S&P 500 over that same period.
S&P 500 intrinsic value grew 365%, 7.2% annualized. S&P 500 stock return was 552%, 8.9% annualized.
So the takeaway is?
The takeaway is clear. Giverny stocks outperformed the S&P 500 by 4.7% per year because their underlying companies grew their intrinsic value faster, about 5% faster per year. It perfectly supports their belief that eventually the stock market does reflect the true value creation of the businesses. It makes you think of that Charlie Munger quote, doesn't it? About getting ahead just by trying to be consistently not stupid instead of trying to be very intelligent. Focus on quality.
Absolutely. Let's tie this all together by looking back again, this time to 2007. You mentioned it was a tough year for Giverny.
Yeah, 2007 was difficult. The market then was led by natural resources, oil especially. And Giverny tends to avoid those sectors. They find it hard for companies to get a lasting competitive advantage there. Plus, as we discussed earlier, but in reverse, the Canadian dollar was really strong then, hitting par with the US dollar. That hurt their reported results in Canadian dollars.
So, out-of-favor sectors and currency headwinds, what did they do?
They stayed the course, stuck to their process. They didn't believe dollar parity made sense long-term. Their message to partners was simple. Patience is in order.
And did that patience pay off over the next decade?
Spectacularly. Look at the 10 years from January 1st, 2008, right through to the end of 2017. The Rochon Global portfolio had a total return of 351%. That's 16.3% annualized.
And the benchmarks?
The S&P 500 in Canadian dollars returned 186%, 11.1% annualized. The S&P TSX, only 58% total, 4.7% annualized. And remember that Canadian dollar, it lost 21% over that decade, back to what Giverny saw as normal levels. But even if you strip out the currency effect, Rochon Global still returned 272% total, 14.0% annualized, versus the S&P 500's 126%, 8.5% annualized.
And what's really key here is that period starts at the beginning of 2008.
Yeah.
Right before the massive crash.
Exactly. These strong returns were achieved starting from the market peak, going through the 08-09 crisis. It shows their companies, while not immune, have the resilience to power through tough times.
So it really comes down to two core ingredients for stock market success in their view.
That's what they say. Two things are necessary. Number one, a rational stock selection process. Number two, patience, often a good dose of it. And, I'd add my own emphasis here. That first ingredient is pretty much futile without the second one.
Right. Process without patience doesn't get you there.
Yeah.
Can you recap their core philosophy one more time? What do they tell new partners?
Sure. They believe stocks are the best long-term investment class. Trying to time the market when to buy, when to sell is futile. They believe a stock's return will eventually mirror the growth in the underlying company's intrinsic value.
And how do they pick those companies?
They look for businesses with high sustainable margins, high return on equity, good long-term prospects, and crucially, managed by people they see as brilliant, honest, dedicated, and altruistic. Then they assess a realistic intrinsic value. It's about business quality and leadership quality.
And the market itself, how does its behavior fit into their strategy?
They see the market as often dominated by short-term players, treating stocks like casino chips.
Yeah.
But they see that irrationality as an opportunity. It allows them sometimes to buy these great businesses for much less than they're actually worth. They know it might take time for the market to catch up, but their view is, if we're right on the business, we will eventually be right on the stock. Returns won't be smooth, some years will lag. Patience again.
So volatility isn't the enemy for them, it's actually an ally.
Exactly. Most investors hate volatility, see it as risk. Giverny embraces it. If you view stock prices in the short term as just what other people believe the company is worth, not its true value, then those price swings become opportunities. Big drops let them buy fantastic companies at attractive prices. They actually say the more that markets are irrational, the more likely we are to reach our ambitious performance objectives.
That really turns the common view on its head. It reminds me of Benjamin Graham.
Right. Graham said the market's irrationality gives the intelligent investor an extraordinary advantage. But, Giverny points out, if you let yourself get swayed by short-term noise anything less than, say, 5 years, you turn that advantage into a disadvantage. Their whole approach is about judging quality over the long haul, which makes patience, R&D, that of our partners, the keystone for success.
A powerful message. As we wrap up, Giverny always emphasizes gratitude to their partners and their role as stewards.
Yes, they're clear that good returns are the goal, but it must not come at the cost of taking undue risk. That focus on solid balance sheets, dominant businesses, buying at reasonable prices, that is their risk management. It's about building wealth steadily, not gambling.
So, a final thought for you, our listener, to take away from this deep dive into Giverny's 2017 letter. Their success seems built on patience, learning from mistakes, and sticking to a clear philosophy, even when things like Bitcoin were grabbing all the headlines. Makes you wonder what short term distractions, what popular trends might be pulling you away from your own long term goals or your core principles right now.
Yeah, maybe consider how applying some of these insights, especially focusing on the underlying business value, not just the stock price swings, could shift your own perspective on investing. It's about understanding what you truly own.